You check your bank app in the dark, thumb hovering over the number, half hoping it somehow reads different than it did an hour ago. It doesn't. And somewhere in that silence, a quiet voice tells you that you're behind. Behind your friends, behind your family, behind some invisible finish line nobody has ever actually shown you, let alone explained. That voice is lying to you. Not gently either. It's been lying for years, using someone else's rented life as its evidence. The new SUV in the driveway, the vacation photos, the kitchen renovation posted at 9 o'clock on a Tuesday night, lit like a showroom. None of that is proof of wealth. It's proof of a monthly payment and nothing more. A costume, not a bank statement. Take Devin. From the outside, his life looks almost unremarkable. Same apartment 2 years running, the same car he bought used off a stranger. No captions, no announcements, nothing to envy. 3 weeks ago, his brakes failed on a Tuesday morning. By Friday, the whole event had already vanished from his memory. Paid, handled, forgotten. That invisibility, right there, is the entire story we're telling tonight, because real financial strength stopped being loud a long time ago. It stopped being something people photograph and quietly became something they simply do. 8 specific things, actually, each one measured against real thresholds that most Americans never clear. And some of you watching right now already cleared 2 or 3 of them without having the faintest idea. So stop scrolling, stop guessing, and start counting. Because in the next few minutes, the picture is going to flip completely. And the person you've spent years quietly measuring yourself against may turn out to be the one standing behind you. Hi, I'm Megan Carter, and if you're new here, this channel exists for one reason: to take the confusing, intimidating world of personal finance and hand it back to you in plain English. No jargon, no shame, just the real numbers behind the money decisions that quietly shape your entire life. Before we get into today's 8 signs, I need 3 things from you, and I promise none of them cost you a cent. First, hit subscribe, because I put out a new breakdown like this every single week, and if today's video resonates, you don't want to miss the next one. Second, tap that like button. It's the single fastest way to tell YouTube more people need to see this, and genuinely, it takes less effort than it took you to open the app. And third, I want to hear from you in the comments. Tell me what country and what city you're watching from tonight. I read every single one, and it always amazes me how far this conversation about money actually travels. Here's how tonight works. I'm going to walk you through 8 specific signs, each one backed by real data: the Federal Reserve, Bankrate, Vanguard, Experian, the Census Bureau. Not guesses, not motivational fluff. Keep a mental tally as we go. Some of these you're already going to clear without realizing it. Some are going to sting a little, and that's fine too, because awareness is the only thing that has ever actually changed anyone's bank account. By the time we get to sign number 8, you'll know exactly how many you've got. And more importantly, you'll understand why the number felt so much lower before tonight than it actually is. Let's get into it. If your car needed an $800 repair tomorrow morning, could you pay for it from money that's already sitting in your account? Not a card, not a buy now, pay later split, not a favor from a parent? That single question is the cleanest financial dividing line in this entire country, and most people fail it without ever realizing they've been tested. Bankrate's 2026 Annual Emergency Savings Report, published this past February, found that just 30% of Americans would pay a $1,000 emergency straight from savings. Not from a card, not from a loan against next month. Only 47% said they even have sufficient liquidity to handle it at all. Not because they're irresponsible, because the math of daily life has left almost nothing behind after rent, groceries, insurance, and gas. So if you can write that check tonight and still make rent on the 1st, you have already cleared a bar that the majority of adults around you cannot. Devin found this out the hard way, or rather, the easy way. His brakes started grinding on a Tuesday, the kind of sound that means today, not next month. The repair came to $640. He paid it from a small buffer he'd built specifically for moments like this, and by Friday, it was already forgotten. One bad afternoon, zero consequences. His neighbor had the identical repair 3 weeks earlier. Same shop, same part, similar cost, except she didn't have the cash, so it went on a card carrying interest north of 20%. She's still paying the minimum on brakes that were resurfaced back in the spring, and by the time she's done, that repair will have cost her nearly double what Devin paid. That's the part nobody explains properly. An emergency fund isn't really insurance against emergencies. It's insurance against your own ordinary bad luck, getting quietly marked up and stretched across years. The interest doesn't announce itself. It just sits there, month after month, converting a bad Tuesday into a bad 2 years. So be honest with yourself right now. If something broke tonight, the car, the water heater, a dental bill you didn't see coming, could you handle it and still sleep fine? If yes, you're already ahead of a genuinely large share of this country, and you've probably never once given yourself credit for it. The Federal Reserve Bank of New York's Household Debt Report put credit card balances at $1.25 trillion as of the first quarter of 2026, with the average rate on balances that actually accrue interest sitting at 22.15%. Run the numbers on a typical balance, and it stops being an abstract statistic fast. It becomes real money, leaving your life every single month for absolutely nothing in return. No product, no memory. No asset, pure rent, on a decision you probably don't even remember making. Now flip it. Take whatever that interest would have cost you in a year, and imagine rooting that same amount into a simple index fund instead, growing at a modest long-term average. Over 2 or 3 decades, that gap, the difference between the person who revolves a balance and the person who clears the statement every month, compounds into genuinely life-changing money. Tens of thousands of dollars, sometimes more, and the two people involved never earned a different income. They just moved in opposite directions with the exact same starting point. Holly runs every grocery run and every gas fill-up through a single rewards card. She's never paid $1 of interest in her life because the balance clears in full, automatically, before the due date ever arrives. The card company still profits, just off the merchant, not off her desperation. That's the correct relationship to have with a piece of plastic, and almost half of cardholders never quite get there. If you've genuinely never carried a balance, you are living in the calmer half of this country, quietly funding nothing but your own progress. Nobody claps for that. There's no trophy for a $0 balance. But it is, without exaggeration, one of the most powerful financial habits a person can build. And if it's already yours, you're further ahead than your checking account balance ever makes you feel. This one is unglamorous, and that's exactly why so many people skip it. The FDIC's national average savings rate sits at just 0.38% as of this month. Meanwhile, the strongest high-yield accounts tracked this July have been paying up to 4.5% APY, more than 10 times that rate, with zero additional risk, zero additional effort, and the same federal insurance protecting every dollar. Put $10,000 in each type of account and wait 12 months. One version hands you a number so small it's almost insulting. The other hands you several $100s. Real money, arriving with no labor attached to it, just for choosing where you park your cash. Here's why this belongs on a list about being quietly ahead. Moving your money costs you about 20 minutes and a routing number. No side hustle, no market timing, no risk tolerance required. Theo transferred his wedding fund out of the bank he'd used since college, the one paying almost nothing, into an insured online account paying real yield. His income didn't change by a single dollar, but that fund now earns enough on its own each year to cover the flowers. If your savings are sitting somewhere that actually respects your money, you already understand something the majority of American depositors have never bothered to act on. It's not a discipline problem. It's an information gap, and you've already closed it. Experian puts the national average FECO score at 703, and FECO's own spring 2026 reading landed at 714, a 2-point drop that marks the first annual decline in the national average since 2013, driven largely by the resumption of federal student loan delinquency reporting. If your score reads comfortably above that line, 730, 750, 770, you're not just fine. You're outperforming a national average that just fell for the first time in over a decade, during a stretch when a meaningful share of people are sliding the other direction. The dollar consequence of this is enormous and almost completely invisible. Lenders save their sharpest pricing for scores above roughly 740. On a 30-year mortgage, the total interest gap between excellent credit and merely acceptable credit can run into the tens of thousands of dollars. On the identical house, the identical neighborhood, the identical closing date. What actually drives that number matters more than people realize. Paying on time, every time, carries the heaviest weight by far, followed closely by how much of your available credit you're actually using. Someone earning a modest income who pays consistently and keeps balances low will routinely outscore someone earning triple that who treats a credit limit like a spending target. Your score has never once cared what you make. It only tracks what you do. Nobody sends flowers for a good credit score. Nothing shows up in the mail to congratulate you. It simply means every major purchase for the rest of your life, a car, a home, sometimes even an apartment lease, costs you less than it costs the person standing next to you, silently, permanently, in your favor. This is the sign that reframes everything, and it's the one most people get wrong, because they're using the wrong benchmark. Headlines love to report the average American household net worth, which sits somewhere north of $1 million, a number that's technically true and practically useless because a small slice of extremely wealthy households drags that average into the stratosphere. The Federal Reserve's survey of consumer finances puts the real median, the household sitting exactly in the middle of the entire country, at $192,900. Broken down by age, it looks nothing like the headline, $39,000 for households under 35, $135,600 for 35 to 44, $247,200 for 45 to 54, $364,500 for 55 to 64, and $409,900 at the peak, ages 65 to 74. That's it. That's the real bar. Grace is 54. She drives a 9-year-old sedan and hasn't taken an international vacation in over a decade. Her mortgage is 2/3 paid off, and her retirement account quietly crossed 6 figures last year. By net worth, she is comfortably ahead of the median household in her age bracket. By appearance, at the office holiday party, she probably reads as the least successful person in the room. That gap between how wealth looks and where wealth actually sits is the whole subject of this video. If you add up everything you own and subtract everything you owe, and the number beats the median for your age group, you are further ahead than the version of yourself that scrolls Instagram at midnight will ever believe. Vanguard's How America Saves 2026 report, drawn from 4.6 million participant accounts, put the average 401k balance at $165,970, but the median, the one that actually reflects the typical worker, was just $44,115. That gap exists because a small number of large, long-tenured accounts drag the average upward, which is exactly why so many people open their statement and feel behind when they're not. An employer 401k match is the only guaranteed, instant, risk-free return available to an ordinary working American. Full stop. A typical arrangement puts in 50 cents for every dollar you contribute, up to some percentage of your salary. Skip that match, and you are politely declining a raise your employer has already approved and is actively waiting to hand you. Run the math over a career and it stops sounding small. Someone capturing a modest annual match, contributed consistently and left to grow for 2 or 3 decades at a historically reasonable market return, ends up with employer contributions alone worth well into 6 figures. The company funds a fraction of that number. Time and compounding do the rest. Colin has never once paused his contribution. Not during a layoff scare, not during a move across the country, not during a year when the market dropped and every headline screamed to pull out. He barely thinks about it anymore. It's automatic, invisible, and quietly becoming the single largest asset he'll own that isn't his house. If that's you, if you've captured the full match without interruption, year after year. You belong in a smaller group than you'd guess, and the balance sitting in that account today genuinely understates how far ahead you already are. Contributions made in your 30s do most of their growing decades after you've stopped thinking about them at all. Gallup's April 2026 survey found that 58% of American adults own stock in any form: direct shares, mutual funds, or retirement accounts, the first meaningful decline in ownership since 2022. And it splits sharply along income and education lines. 87% of households earning $100,000 or more own stock, compared to just 28% of households under $50,000. College graduates sit at 84%, adults with a high school education or less at 42%. That divide explains more about the widening wealth gap than almost any other single statistic, because when the market climbs, it climbs specifically for the people already holding a position. Everyone else reads the identical headline about a record high and feels nothing from it. The barrier to entry has never been lower. Fractional shares mean a few dollars buys real ownership. Broad index funds carry fees so small they barely register. The obstacle was never the minimum investment. It was simply knowing the door existed and having the patience to stay in the room during the years when the number goes down instead of up. Naomi started investing $250 a month into a broad index fund years ago and has never once stopped. Not through a rough stretch, not through a scary headline, not through a single month where every instinct told her to sell and wait it out. That behavior, far more than the dollar amount, is what put her ahead of people earning considerably more than she does. If your retirement account is actually invested rather than sitting in cash, if you own index funds, if you kept contributing through a month that felt frightening, you're participating in the exact mechanism that builds real American wealth. A large share of lower-income households simply aren't yet, through no fault of their own. If you are, you're standing somewhere most people never reach. The Census Bureau puts real median household income at $83,730 for 2024, statistically unchanged from $83,060 back in pre-pandemic 2019, which means, for most people, the raise was never really the variable that mattered. What mattered was what happened in the 90 days after the raise landed. Here's the pattern that quietly eats most financial progress in America. Income rises 7%, and within a season, a new car payment appears, a bigger apartment appears, a subscription stack multiplies, and monthly obligations rise even faster than the raise did. The paycheck grew, the margin shrank, and the person genuinely can't explain where the extra money went because it was absorbed before it was ever visible. Vanessa took a promotion worth roughly $9,000 a year and changed nothing about her life on purpose. Same apartment, same car, same grocery routine. The entire raise routes automatically into savings and retirement on payday before she ever sees the number in her checking account. Her lifestyle didn't improve at all. Her financial position improved permanently, and from the outside, there is nothing whatsoever to see. No new car in the driveway, no visible reward for arguably the smartest financial decision she made all year. What makes this work is automation, not willpower. A raise you have to consciously decide not to spend every single month for years eventually gets spent. Nobody wins that argument 365 days a year. A raise that moves automatically on payday never enters the argument at all. If your income went up recently and your monthly costs didn't move with it, you just built the one engine that funds every other sign on this list. So count yours. Cash for a real emergency. No revolving balance. Money earning what it's actually worth. A score above the national average. Net worth beating the median for your age. The full employer match, captured without fail. Real ownership in the market. And a lifestyle that never inflated to match the paycheck. Clear 3 of those, and you're already ahead of a startling share of this country. Clear 5, and you're in genuinely rare company, regardless of what's parked in your driveway. And if you somehow cleared all 8, the only reason you ever felt behind is that the people you were actually measuring yourself against were never the ones ahead of you to begin with. That feeling of falling short was never really about your bank account. It came from holding your private reality up against somebody else's public performance. A comparison that was rigged from the start, because you were measuring your savings account against their spending account. If tonight reframed anything for you, tell me which sign hit hardest, or which one you're still working toward. Where are you watching from tonight? Drop your city and country below. I read every comment, and I promise you, wherever you are not the only one recalculating right now. And if you're sitting at 0 out of 8 tonight, say that too. Every single person who's ever cleared all 8 started exactly there,